Well, we talked about reducing the estate tax in all these different ways. How about ways to pay it? One of the most obvious, and many of you have them, are life insurance trusts. There are a couple new things that I want to bring up for those of you that have these, and those of you that don't, this is your year to consider it. So most of us have some kind of life insurance. Term, universal, some kind of life insurance. Others of us have a lot of life insurance because at different stages of your life, you want life insurance to pay off a mortgage, you want it to be able to handle a business, and as you keep growing, you need it to pay inheritance tax. And that's what we're talking about here. Because in most cases, if you did it right, you'll never pay $1 million in premiums for $1 million in death benefit. So the leverage concept is very good. So whether you need life insurance for your estate or whether you already have life insurance, you say, I'm too old, I can't get new insurance, it would be too expensive, I have this medical condition, that's fine. We're talking about what to do with your existing insurance as well as those of you who are healthy and should be getting insurance to pay an estate tax. So what's the concept? The concept is it is irrevocable. It's an irrevocable trust, but it's designed to own life insurance to start the policy and then eventually the proceeds. And anything that's in that ILIT is completely inheritance tax free. So if you have $1 million policy with the rest of your trust, it's taxable. When people go, oh, isn't life insurance tax free anyway? You're mixing it all up. No. Life insurance in an estate is inheritance and estate taxable. You're talking about income tax. When the policy comes in, there's not income tax on the check they give you. That's correct. But if it's still part of your estate, it's inheritance taxable, 40%. So we don't want to just puff up an estate. Let's say you have an estate that's, the exemption's 11 and your estate's 15. You say, well, I want to get some insurance. Don't just add insurance. You've just puffed up your estate to be even higher. Instead, you transfer a policy, either existing or new, to an ILIT. The beauty of this is one of my favorite things is the second one. Do you see what it says? It says the amount of the gift is what? Anyone? Cash value. That's the fill in the blank. It's the cash value. So if you have a policy that's got $1 million death benefit, but it has $200,000 in cash value, when we transfer that policy, we only have to use up $200,000 of your exemption. But we just moved $1 million in free. So it's fantastic. We only have to use the cash value. If you have term insurance, you didn't use any of the gift. You just move the policy in, and there's zero use of your exemption. So this is a very important issue to move assets like insurance into the irrevocable trust. Now you've removed the death benefit as well. One of the things that's critical is the choice of the right insurance. It controls what? It controls the cost. I am anti-clients overspending for insurance they're not even going to need. It's just awful. Why should they have the cash flow burden of that? They shouldn't, so that they save the kids more money? That just doesn't make any sense. So we have to make sure the cost is low, make sure the cost is appropriate, and it's the type of insurance that helps with that dramatically. Existing insurance trust, any of you with insurance and or with an insurance trust, it's the policy itself that has to be reviewed every 3 to 5 years. The ILIT's already done. It's permanent. It's the policy inside of it that has to be reviewed every 3 to 5 years. Why? Because you may not know this, but policies are changing dramatically. The insurance industry has continued to evolve. But you might have a policy that you give us that shows you named the right beneficiaries and everything's good. But if we looked at the policy illustration, those were projections when you bought that policy. They were saying if the stock market does this for the next 10 years, and if interest rates do this for the next 10 years, then here's what your policy is going to look like. Well, we haven't had it going like this, and we haven't had it going like that, so you're allowed to ask for what's called an in-force illustration. And we do that for you and with you. But that's where you get an actual calculation from the insurance company on where your policy really sits, what real cash value you have, how it's growing, how much can you borrow against it, etc. So that's why every 3 to 5 years is very important to have that reviewed. Just so you know, we don't sell insurance, as most of you know, but over the years we have found wonderful independent experts that we offer as a resource to our clients. There's no remuneration, there's no connection with us financially or with them. We offer it as a service to our clients because the last thing you need to do is call the same agent you had and have them sell you more. I mean, that's not the goal. Not that we can't work with your agent, but you need to have someone independent analyzing this, and we have those services available at no charge for our clients so that their insurance is handled beautifully.